For centuries, one rule in finance has persisted. When crisis strikes, wealth runs for cover under the ultimate, untouchable safe haven: physical gold. Today, the world faces severe geopolitical tensions, and active conflicts are dominating the headlines across the globe. But look at this graph tracking global conflict against gold prices. The red line of conflict is surging upward, yet the price of gold is taking an active nosedive. Traditional market theory suggests gold should rise, but current data shows the opposite. The law of financial gravity has inverted. This breakdown occurs within the invisible plumbing of the global economy. The chain reaction starts with energy. When international conflict erupts, supply chains fracture. That uncertainty instantly drives up the global price of crude oil. Because almost everything requires oil to produce and transport, those higher energy costs lead to a sharp surge in inflation across the economy. Expensive oil pushes the inflation gauge into the red. To cool it down, central banks must raise interest rates. Suddenly, safe assets like fixed deposits pay hefty guaranteed returns. Compare that to physical gold, which pays exactly 0% interest. Investors respond by pulling their capital out of precious metals. They migrate toward assets that actively pay them to hold cash. When guaranteed yields hit a tipping point, stagnant safe havens are abandoned for actual profit. There is a second force working against gold, rooted in the currency market. The US dollar is the world's primary reserve currency. When the US raises its interest rates to fight inflation, foreign investment pours in to capture those yields, making the dollar exceptionally strong against competing currencies. On the international market, gold is almost exclusively traded and priced in US dollars. This animated seesaw illustrates the math. The heavier the dollar gets, the higher the price of gold gets pushed for anyone buying with a foreign local currency. International buyers are effectively priced out. As a result, the global demand for gold plummets. A strong dollar acts as an invisible tax on gold. It chokes off demand and suppresses the price, regardless of global panic. A third factor stems from the broader financial chaos. When war breaks out and rates spike, major risk assets like equities and cryptocurrencies suffer sudden crashes. Institutional investors holding those plunging assets face margin calls and a desperate, immediate need for cash to cover their losses and protect remaining profits. They need liquidity. Despite being heavy physical metal, gold is one of the most highly liquid, easily sellable assets on the planet. Investors use gold specifically because it is the fastest way to generate emergency cash. When you multiply this behavior across the macroeconomy, mass liquidations flood the market with excess gold supply, driving the price down further. In a systemic market panic, investors don't hold what they want to hold. They are forced to sell whatever they can. Gold's intrinsic value remains, but it is currently losing a tug-of-war against high yields, a muscular US dollar, and desperate liquidity needs. This situation exposes a critical principle. Opportunity cost is a stronger driver of capital than geopolitical fear. In a hyper-connected global economy, you cannot predict asset prices just by reading the battlefield headlines. You have to analyze the alternatives competing for that same capital. Because when the global financial system squeezes tight enough, cold, hard cash, not gold, becomes the ultimate king of safe havens.